A better way to find stocks to trade. How do you select stocks to trade? Do you study a company's fundamentals? Do you base your pick on what the stock usually does seasonally? Perhaps you heard a company's executive on a financial TV channel promote his stock. Do you buy a stock on news or on the advice of an internet guru, or a tip from a friend? Maybe you select stocks by following social media, Reddit stocks. Watch this video to uncover the best way to find stocks to trade, but first, please take a moment to like our video and subscribe to our channel. One way to select stocks to trade is to use theoretical probabilities, using statistics to put the odds in your favor. This is especially true for option trades. A study found that a blindfolded monkey throwing darts at a newspaper financial page picked stocks to make up a portfolio, which did just as well as a portfolio of stocks picked by a professional trader. Without getting too deep into the math, traders can get an idea of the range a stock is likely to move in the near future using the concept of standard deviation. You might remember the bell-shaped curve from high school math class. This plotted graph resembles the silhouette of a bell, having a camel-like hump in the middle, which thins and flanges out at the left and right bottom sides. A standard deviation plot shows how data, numbers or items are naturally distributed. Simply put, statistics state that 68.2% of the data or items will lie within the area under the curve marked by 1 standard deviation. About 95% will fall within 2 standard deviations. Obviously, at 2 standard deviations, the odds are extremely high. Finally, about 99% will plot within 3 standard deviations. The bell curve shows a normal distribution that occurs naturally most often, and is symmetrical. Half of the data will fall to the right of the center, or mean, line, and the other half will fall to the left. So, standard deviation measures the distribution of a data set relative to its mean. In the field of education, test scores follow the standard deviation pattern. In medicine, where your blood pressure number falls on a bell curve will tell your physician if your pressure falls within the area considered normal. Standard deviation plays an important role in financial markets, especially in trading options. This is because standard deviation shows expected move, that is, a price range in which a stock's price is likely to trade within during a specific period of time. The standard deviation determines the width of the bell curve. The area that defines the bell curve regarding a stock or option depends on the security's volatility, that is, how wide a range it moves over a certain period of time. Regarding options, implied volatility, or IV, is a representation of one standard deviation move over 1 year. So, a stock's options volatility is used in predicting the expected move of the stock. Take a bell-shaped curve and draw a line down the center, from top to bottom. Draw a line from the top to the bottom a little ways to the left of the center line, and a line to the right. These lines define the area of one standard deviation. Of course, where these lines are actually plotted will depend on volatility. This represents the area in which there is the probability of a stock's price falling in this range 68.2% of the time. Research by tastytrade.com examined 1 year of data on IWM, which is the ticker symbol for an exchange-traded fund, ETF, that represents a basket of stocks that make up the Russell 2000 index. This is an index of small-cap stocks. The researchers wanted to see if IWM's price would move within the range of 1 standard deviation 68.2% of the time, as statistics predicts. The result was that it did move within the predicted range 75% of the time, which is slightly above the theoretical odds. Another study from the Tasty Trade researchers looked at 30 stocks over a period of 1 year to see if during a 30-day period the stocks would move within their predicted standard deviation 6.2% of the time. Most all of them landed within the 1 standard deviation range. Try basing your trades on stocks and options where statistics can lean in your favor. Trade stocks that are highly liquid, that is, whose average daily volume is over 2 million shares. Use standard deviation values to predict the range a stock will move. Bollinger Bands is a technical indicator that defaults to 2 standard deviations, and it shows the current predicted range. Also, check the spread between the bid and ask prices of both stocks and options. A spread of 20 cents or less typically indicates that the security is highly liquid, and that the pricing is fair. In summary, determining the range a stock or option might move will increase your odds of a successful trade.